Hello everyone and welcome to Atomic ACCA's pre-mock exam solving series, and in this video we are going to look at the final question for section C, Financial Reporting March 2025 exam. Now the requirements are around the interpretation question. Calculate the ratios for Supergoods company for the year ended 30th September X3 equivalent to those shown for sector average. So you can see that sector average ratios are given over here. So you have to calculate all of this, and that's worth 8 marks. So when more ratios come up in your question, consider that as a blessing, because that is all easy marks to score. And keep in mind, you do not stand a chance of missing out any information over here or any ratio over here. So make sure as part of your practice, you know all these formulas by heart. They're not going to give it to you in the question, so you have to learn it by heart. Do not miss out anything, because if they ask for a particular ratio and you don't know it, it means you're losing a simple easy 1 mark over there, and that could be the decisive factor that's going to cause you the pass or fail. So make sure you know all the formulas for ratio calculation. Second part, using the ratios calculated in A above and the information given, analyze the financial performance and financial position of Supergoods company. Your answer should include a discussion on any additional information that is necessary to obtain better insights into analysis. So there could be some missing information over here. You could just randomly say, when you're explaining about different things, what other information could be more useful in order to help you with your analysis part, and that's altogether worth 12 marks. Now we can start slowly doing this question. Supergoods company is engaged in manufacturing home appliances, which it distributes through a network of dealers and departmental store throughout the country of Zealandia. So they are more dealing with, you know, wholesale sales. Okay, retail, wholesale, like a wholesale. So they're going with departmental stores and dealers. So it's wholesale. Market for home appliances is very competitive. Okay. Following data shows some of the key ratios for the home appliances industry. So gross margin, operating margin, interest cover, gearing, that we have to calculate by this formula, debt by equity. So don't use the other formula, debt by debt plus equity. So that's not needed. Current ratio is there. Inventory holding period, receivable collection days, return on year in capital employed. Okay. Extract from the financial statement of Supergoods company for year ended 30th September X3 is given. SOPL is given to us: revenue, gross profit, operating profit, finance cost, profit before tax, tax profit. Okay. So SOPL is there. And SOFP is given: non-current asset, PP, intangible asset, current asset, inventory, receivable, total asset, equity, non-current liability. We have current liability and total equity plus liability. Okay. Then following information is also relevant. The PP includes a property acquired. Okay, PP. Where is PP? Okay, PP includes a property acquired by Supergoods company some years ago. Property has been recently revalued, which has resulted in the revaluation surplus as shown under the equity. Okay, that is this one. Then the plant and equipment have been in use for many years, and the company is now considering to replace it with modern equipment. So they bought the asset some years ago, and the plant and equipment has been in, okay, that is about one asset only. The plant and equipment has been in use for many years, so the assets they have is old, and they're considering to replace it with modern equipment. So it's very important that you have to talk about the discussion about companies having or relying as of now on old assets, and they need to invest into new assets, which would enhance the quality and efficiency, which means currently quality and efficiency is quite less. That's why they're planning to shift it into new modern equipments. Intangible asset include patent. Where is it? Okay, 7.5 million intangible asset. The life of the patents amounting to 6.5 million would expire in the next 2 years. Okay, out of 7.5 million, intangible assets worth 6.5 million would expire in the next 2 years. So that means that also needs an investment. So assets, non-current plant and equipment needs investment. Intangible asset needs an investment. Then the company sells its appliances mainly through the dealer network, that is where wholesale, which is 80% of its sales on an average. Balance comes from retail sale, that is directly to customer. Industry has shifted to retail sales in the recent past. Okay. 8% loan notes were issued 3 years ago and would be due for repayment in 20x5, which is 8%. Okay, borrowing 8% loan note were issued 3 years ago and would be due for repayment in 20x5. What is the year ending? 30th September X3. That means within 2 years that is due for replacement. I mean, sorry, repayment. Okay. Company paid a dividend of 4.5 million in the current year. Some directors had questioned the propriety of this huge payout that increased the bank overdraft. So directors means the management is not very much, focused, or management is not really okay with this particular thing. So if they are not okay with this thing and still they decided to take some overdraft and pay the dividend, that means probably shareholders are forcing them to do. Now there is no information given about here how past dividend patterns have been. Maybe they are forcing because past they have not been paying out, so this year they wanted a huge payment. So that could be the reason. Again, that's information lacking over here. That's why they specifically mention in the question over here what extra information that is necessary to obtain better insights into analysis. We can talk about that as well. So we got a basic idea about what information is over here, what is the case study and all. Now first thing is, for 8 marks we have to do the calculation bits. For that we can use the table that is given over here. Now what all things we have to write in the table? Number 1, we need the titles, so there will be one for that, and 1 2 3 4 5 6 7 8. So there's like 8 ratios over here. Okay, 8 plus 1, so 9. This is column. Okay, so this is row, so 9 rows are going to be there. Then first column is about the titles. Second column, just for comparison purpose, we can copy paste the sector average. Third, we need the company specific ratio which we have to calculate. Fourth, we are going to show the working as well, which is very important in the ratio calculation, because if in case the final answer goes wrong but the working is correct, somehow let's say while typing, if something went wrong and if the final answer is wrong but the working, all the numbers are correct, then we get marks. But if we don't show the working and if we show only the final answer, and if by chance that final answer went wrong, then you lose marks over there. So to be on the safer end, make one extra column in order to write what your workings are. So let's make this table. We need, as said, 1 2 3 4 5 6 7 8 9. Then one for call titles, one for sector average, one for working, one for company. Okay, so this is how our overall structure would look like. Now this is the ratio. This will be the, okay, we'll take working. This will be super goods company, and this will be the industry average or the sector average. We'll just write down the titles. First one is gross profit margin. Next one is operating profit margin, interest cover, gearing, which is to be calculated as debt by equity, current ratio, inventory days or inventory period, receivable days, then finally ROC. So we have all the formulas ready. Industry average is given, so we can copy paste that down. 45 percentage, 17 percentage, 8.3, 40 percentage, 1.75 is to 1, 45 days, 25 days, 29.4 percentage. Next is we have to do these working for the super goods company. So gross profit margin means gross profit divided by revenue. So what is gross profit? 42,000 divided by revenue is 120. Operating profit margin, and this will be into 100. Then operating profit margin is PBIT, so that is 13,200 divided by 120,000 into 100. Then interest cover is PBIT by interest. So PBIT is 13,200 divided by finance cost is 2,950. Gearing is debt by equity. So debt is, we have to take the non-current liability, that is 28,000 divided by total equity is 33,500. Current ratio is current asset by current liability. So current asset is over here. Inventory, receivables, total is 37,700. And current liability is over here. Trade payables, overdraft, tax liability, that is 34,200. Inventory days is inventory by cost of sale into 365. So inventory is over here 2,200. 2,200 divided by cost of sale is 78,000 multiplied by 365 days. Okay. Receivable days is receivables by revenue into 365. Where is receivable? Trade receivable 17,500 divided by revenue is 120,000 into 365. Then finally ROC is PBIT by capital employed. PBIT is 13,200 by capital employed is non-current liability by equity. Non-current liability is 28,000 and equity is 33,500. So we are done with all the formulas over here. So as said, now we wrote the formulas over here, which means if the numbers we took down is correct, we get marks for ratios even if our final answer in the next column goes wrong. But be careful, don't write the final answers wrong. Like, purposefully don't make it wrong, because your analysis will be based on what calculations you have here. So let's take the calculator in order to do this. First one is 42 divide oops, 42 divided by 120 into 100, that is equal to 35 percentage. So that is bad, less than industry average. Next one is 13.2 divided by 120, that is equal to 11 percentage. Next one is 13,200 divided by 2,950, that is equal to 4.47. 4.47 times. Next one is gearing, 28 by 33.5. 28 divided by 33.5, that is equal to into 100 is equal to 83.58 percentage. So that's not good. 83.58 percentage gearing. Current ratio is 37.7 divided by 34.2, that is 1.102. 1.102 is to 1. Then inventory days is 2,200 divided by 78,000 into 365 days, that is equal to 94.5 days. 94.5 days. Receivable days is 17,500. 17,500 divided by 120. 17.5 divided by 120. 17.5 divided by 120 into 365 days. So that is 53.23 days. And finally we have ROCE, that is equal to 13,200 divided by 28,000. 13.2 divided by 28 plus 33.5, that is equal to 0.21. So if I multiply this with 100, it will be 21.46 percentage. 21.46 percentage. Just calculate this once again. I think I made a mistake. 13,200. Okay, what is the denominator? 28,000 plus 33,500. 61,500. So 13,200 divided by 61,500 into 100, 21.46. Okay, correct. So getting on to the next main part, which is the analysis bit, and that's our main scoring area over here. Let's begin. Okay. So we need a performance analysis, we need a position analysis. So first let's start off with performance analysis. Now, regarding performance, we have gross margin, operating margin, interest cover, and that's it. Then we have gearing, current ratio, inventory, receivable, ROC. ROC is part of performance analysis. So we have four ratios here related to uh, position analysis, four ratios here related to performance analysis. First, we can utilize these ratios and see what points we can build. Then from the case study, what extra information is needed, we can take from that. Though the question is for 12 marks over here, it's not mandatory that you have to split across 6 and 6 marks. Rather, you can do it like 5 and 7 and all. So that's possible based on the points that you're getting. So that's totally okay with it. So let's begin. First, about gross profit margin, always tell that how the margin is performing in comparison to the industry average. So the gross profit margin of Super Goods Company is 35 percentage, which is 10 percentage less than the industry average. Now this is just to pace up your answer. Now you have to say what could be the reason for this. Now, how is gross profit margin calculated? Gross profit by revenue. Now two elements are coming in bit in this particular section. This is all calculated on the basis of revenue, cost of sale, gross profit. About cost of sale, we don't know specifically what is included in this, or what kind of inventory is being there, or what margins are they setting. So these are missing information. But something that we can analyze over here is revenue. They are selling mostly, it is told that 80% is for retail. No, 80% is for the network, that is wholesale. That means when you're selling wholesale, there are chances that the margin that you can set on this will be less. And it is told that industry has shifted to retail sales in the recent past. So maybe in that recent past, because they started to sell out to direct customers, that is the reason why maybe gross margin could be higher than Super Goods Company. So this point we can make over here. So the characters we are connecting over here is revenue and cost of sale. Okay, so first about revenue. The revenue of Super Goods Company, or you can say the revenue profit margin for of Super Goods Company could be comparatively lower than industry average because 80% of their sales are through network of dealers and supermarket, right? What was given in the initial, somewhere it was given. Network of dealers and departmental store, not supermarket. So departmental store. So now we understood one reason why margin could be less. So this is one reason, network, while The industry recently moved to retail sales, gaining higher margin. So we got 1 point over here. Another thing we told was about cost of sale. We don't know what kind of product is being sold. More information about more information about the different types of product sold can help in improving the analysis. Done. So we're done with the gross margin analysis part. Second one coming up is operating margin. Operating margin, now we can write the first line. The operating profit margin is standing at 11% compared to 17% of industry average. Standing at 11% compared to 17% of industry average. Now, what is coming up after this? Revenue and cost of sale, we already are done with the discussion. So, after this in SOPL, in order to reach to that PBIT, what is coming up in between? Operating expenses. Now, just consider what could be the operating expenses that is there from the story over here. Now, first is about PPE. We told that they're trying to enhance the quality and efficiency, which means modern equipment investment is needed, which means currently if they are having old assets with them, probably the maintenance cost or other kind of service cost and all could be higher. That could be a reason. Number two, if it's an old asset and in the market value is less, if the company is following IAS 16 revaluation model, they would have recorded an impairment on that. That impairment could be recorded over here. So that could be one reason why the admin expense could be higher. Apart from this, intangible asset, we don't know. No information is there. Amortization related to intangible asset goes to the SOPL part. But again, we don't know whether the other companies are having intangible asset or not. So that's not a very clear information. Company sells through this one, so that has nothing to do with this. Okay, that has one thing, that is they're selling to departmental stores. So chances are there that they have distribution cost. They are going to the departmental stores and selling. So distribution cost could be there. On the other hand, maybe we can assume that on a retail sale, customer is coming to the warehouse or coming to the company and buying it. So in the industry, maybe the distribution cost would be comparatively lesser than this one. So that is one information we can pick out from there. But again, there's a lot of clarity less in that particular information as well. This is more assumed from that particular case study. Loan notes is related to finance costs, so it has nothing to do with this. Company paid a dividend, overdraft pays interest. Again, that's all about the things coming after PBIT. So nothing related to admin expense. So we can bring up information over here. Number one, as super goods company uses currently old assets, there are chances that maintenance cost could be high, leading to high operating expense. Moreover, older assets is an indicator of impairment which could have been recorded within the operating expenses. This could be a reason for low operating margin. Another thing we told is about distribution cost, low operating margin. Another reason could be that as super goods company sells mostly to departmental stores, they may have to incur huge delivery cost in terms of delivering in large vehicles. Maybe they'll have to use truck and all these things. On other hand, as industry mostly sells to mostly sells through retail, the distribution cost could be comparatively less. But again, that is an assumed information because they didn't give the split exactly about how much is the distribution cost. They just gave one title about operating expense. So you can say over here more information on the breakdown of administration expense, or sorry, breakdown of operating expense can help in further analysis about the cost control. So we told the second part as well about performance analysis. Third information is about ROCE. How is ROCE calculated? PBIT by capital employed. Now PBIT discussion is already over here. We told why operating margin is going down and all. So we don't have to talk about that. So what we can talk about is the capital employed, the denominator part over here. The ROCE of companies 21.46 percentage, 21.46 percentage, while for industry it is 29.4 percentage, 29.4 percentage. Now the reason for this lower ROCE could be as mentioned above due to lower operating profits. So you don't have to explain again about why this operating profits could be less because that discussion is done. So now we can talk about the discussion with capital employed. What is there in capital employed? We took non-current liability. Where is it? Oh yeah, non-current liability and equity. So if we go down, we can see that non-current liability is some borrowings 28,000, and when you have equity, that is 33,500. Now if now ROCE and the denominator is like inversely proportional, that means if denominator is going up, ROCE will go down, and if denominator goes down, ROCE will go up. Now over here you can see that currently the difference is only like this much, 21.46 and 29.4. Okay, that means, so over here, if in case, and if we analyze the equity part, you can see that equity is ordinary capital plus revaluation surplus plus retained earnings. It was told about revaluation surplus that it happened suddenly in this 1 year. Now revaluation surplus is not like an annual thing, nor it is like an extra capital that is introduced in the company. So that is not something that you can rely too much about. Now if we remove that revaluation surplus, automatically equity figure will go up. But if you analyze from another point of view, equity, that is share capital, that is equity capital, non-current liability, all that capital is there. But another main capital for the company is asset. Now we know that they have told about the PP being very old over here. That means the investment into assets are coming very soon. If investment into assets come out, what will happen? The overall asset balance will go up. That means the denominator capital will go up. If capital goes up, ROCE will fall down. So that can be one point over here. If we talk about the other denominator, that is the liability, there is currently lot of overdraft, but that's not considered over here. Only the borrowings are considered, but that also they told it will be repaid in 2 years time. If it is repaid, then what will happen? The overall borrowing figure will go down. If borrowings go down, ROCE will go up. So there's like two situations that's happening over here with regards to assets as well as liability. You can talk about all this over here. So speaking of the capital employed, let's break this down one by one. The equity included within the calculation involves revaluation or includes revaluation surplus which is not exactly a capital input into the company that company can utilize. Moreover, currently the carrying value of assets could be less. Current carrying value of non-current assets could be less. If non-current carrying value is less, denominator is less. That means ROC is high. But this will not last longer, as these non-current assets are to be replaced soon. Hence, when non-current asset balance increases, ROCE would fall further. That is, denominator increases, ROCE will fall down. Another element of ROCE, another element of capital employed is the capital employed is the 8% loan note. This has to be repaid within 2 years, and if not replaced with another loan, that is, it's not like if you replace pay this amount and get another loan, means that liability will stay as it is. But if in case you are repaying and you're not replacing it with another new loan, in that case the company denominator would fall, meaning that liability figure will fall. If liability falls down, there is a chance that ROCE could go up. So this is the information we're bringing here. So this has to be repaid within 2 years, and if not replaced with another loan, then the liability would fall, causing the ROCE to increase in future. Done. So that information is enough over here. Next thing, what is the last one we have? Interest cover. Now interest cover, you can see it's almost half of the industry average, so it's like way less than the industry average. What does interest cover mean? The ability for you to cover up your interest payments. Now, if we have to talk about interest, we have to currently see what is the overall liability situation, what is the cash position and all. Based on that only we can get an understanding how they are performing. Now, if we look over here, there was a note mentioned about the fact that in order to pay the dividend, that overdraft was used. That's why directors got worried about increasing overdraft limit. Secondly, you can see that this borrowing is to be repaid in very short period of time, in 2 years time. If you look at the current asset, you can see that there is no cash balance also. And there was a first point mentioned that in order to increase the operating efficiency, lot of PPE in this has to be replaced. That means there's a lot of expense that is going to come up, a lot of cash outflow that is going to come up in the near future, but company's cash position is very weak. Considering that, there is a high chance that company will have to raise further loans in the coming years, and if they have to raise it, this interest cover is going to significantly go down further. So that is at a little bit, you know, struggling situation or a struggling figure for the company. So we are going to bring up this point. The interest cover currently for super goods company is 4.47 times, while for industry it is 8.3 times. Considering that company has taken consider a reason for this low interest cover can be an indicator from directors being worried about the overdraft increasing for meeting dividend payout. Moreover, as investment in non-current assets, repayment of loan is needed in the near future, with company currently having no cash balance, there is a high chance that they may have to raise further funds in future. This will cause the interest cover to fall further below the existing levels, which may lead to a struggling situation for the company. So company, as they won't be able to meet the interest payments. So done. So we're done with 4 big points about all the discussion around the performance analysis. We didn't have to use any extra ratios like dividend cover or any other ratios. Whatever existing figures were there, we were good enough to make a lot of explanations about this. So that is good enough for a performance analysis over here. Now we can move into position analysis. As part of position analysis, main discussions were around first point told about non-current asset. So that itself can be one discussion over here. If we have to use the formulas over here, gearing, that anyways we'll have to talk one about the financial situation. Then current ratio, inventory period, receivable days, this we can almost club it together when we are talking about the current ratio and the overall liquidity position. So non-current asset can be one discussion, liquidity can be one discussion, then financial situation can be one discussion. Now it's when we talk about three discussion, it's not that we are getting only 3 marks. Through that three discussion itself, we'll be bringing up many points. So automatically whatever the marks we need, we're going to capture from these. So first about non-current assets. Currently the company has non-current assets which is comprised majorly of old assets and requires significant replacement with modern assets soon. Considering the current financial situation, it seems that super goods company won't have the money company don't have the money with them for purchasing new assets. It can be assumed that some cash could be raised by selling old assets. However, this will not be sufficient. The remaining amount may have to be the remaining amount should be funded from outside, but considering a repayment of 8% loan note approaching soon, this borrowing being available for replacement of non-current asset is also a doubtful situation. So what we basically told over here is, if that replacement has to happen, they need money. Partially they can make it through selling the old assets, but remaining they'll have to borrow it from outside. But considering they have to repay an existing loan itself, without repaying that, getting a new loan could be a very difficult situation. So that also is a question mark. So this is what we put up as a discussion regarding the non-current assets. Next thing, the discussion we told is about the liquidity and the current assets part. So this discussion we are going to take from all of this together. Now we can talk one by one. Currently the company's receivable days is lower than this one by how much? Oh sorry, not lower, higher. Receivable days is higher than industry average by how many days? 25, 50. So 25 and 28.23 days, by 28.23 days. This could be because the company is majorly selling to departmental stores, which may be sales on bulk quantity where extended credit terms are given, while industry could be doing and industry could be doing and be doing a retail sale which could be on cash or lower credit period. Done. So that is over. So we told about receivable days. Secondly, next thing is the inventory period. Currently inventory days, okay, we can write one more point. This high receivables also is an indicator of bad debt or allowances to be recorded, but further information regarding this is needed to build on analysis. Currently inventory days is almost double of the industry average. Okay, inventory days is almost double of the industry average. Now what kind of product are they selling? Home appliances. Now regardless of whether they're selling to retail or to wholesale, whatever it is, if inventory days are increasing, either the indicator is that they have too many goods with them and they're not able to sell it out. Okay, so a lot of inventory and not being able to sell out, so there are high chances that goods are not going out, and if that is there, it means that many inventory might have to be sold on a discount over here. If they're going to sell on a discount, it is an indicator that NRV could be less than the cost, which is an indicator of impairment on the inventory as well. So inventory days can be high when, if the whole industry everyone is having high, but on the situation over here, industry average is not very high, only for our company it is very high, so that means it's not a good indicator, we can say something is wrong. So currently inventory days is almost double of the industry average. This is an indicator that super goods company is not able to sell their products well in the market, considering that there is huge competition. How do we know there is huge competition? Because it was told in the first paragraph over here. Market is very competitive. Hence, this high inventory is an indicator of obsolete goods where net realizable value could be lower than cost and hence an impairment required. but more information is needed on what kind of inventory is being stored with super goods company to understand this further. So we told about that one as well. Next discussion was about current ratio. Overall low cash balance and overall we can just start the normal way. The current ratio of company currently is 1.10 while it is 1.75 for industry. 1.10 while for industry it is 1.75. Yes. Now current ratio shows looks like it is greater than current liability, that is 1.10. But what is the meaning of current ratio? It means that you are able to clear off your current liabilities quickly if something comes up and you want to clear everything today. But out of this, from the previous two paragraphs, it's already understood that inventory days is very high, so you're not able to sell this properly. Receivable days is high, so there is an indicator of bad debt as well, which means even though the current asset figure is high, these money is not sure, or they are not even sure whether they can recover out of this, which means even though the figure looks nice and it is, it is greater than 1, based on being little more practical, this is not the exact situation with the company. Most of this is not going to be liquid very soon, so the liquidity position also is in a bad position, also considering the fact that company has no cash balance. So we can bring up this point. Though the ratio is greater than 1, this is a manipulative figure. As understood from the above mentioned information, high receivable and inventory days is an indicator that cash is stuck within these and not liquidable easily. Moreover, company has no cash balance either. This overall shows that liquidity position of the company is severe. Done. So we told about that. Finally, the gearing position about the equity and the debt and all. Now here we can say that the current gearing level of the company is how much? 83 and 40. So is double of the industry average. Now it must be noted that only long-term borrowings are considered here. The company is relying on a high overdraft balance as well in order to meet their dividend payments. Currently, company has no cash balance, and moreover, cash balance wait company is relying on a high overdraft balance as well in order to meet their dividend payments and has no cash balance. Okay. Hence, this overdraft is a significant borrowing for the company, and if considered within the gearing calculation, the gearing level would increase even further. Previously, we made a discussion about low interest cover and how this could go down even further. So you can say that as well, or you can connect to the point about this debt being repayable or overdraft already reaching its max limit and you are not able to get any more overdraft in order to clear your future dividend payment. Anything you can discuss, like there's a lot of points to discuss. I'll just write down, but it's not mandatory that you have to write everything over here. Okay, so just write few points. Considering that interest cover is low and debt repayment is in 2 years, coming up in 2 years, there are chances that company will not be able to repay this amount because no cash available, and even raise any amounts in future, causing an indicator of going concern uncertainties for the company. Means existing loan not able to repay, not able to gain more debt either, which means you will have a significant financial crisis in your company, which will cause a going concern problem. So we told about the financial discussions over here. Finally, we can just conclude all of this together. Conclusion: there is profit in the company 8,200, but cash flow is more important for the company than profits. We can bring up this point. Though company has a profit after tax of dollar 8,200 million, yes, 8.2 million, cash flow is more important than profit figures. Currently and in the near future, the company's existence looks critical based on the information available. However, to compare better of its performance and position in the market, more information about the companies chosen as the average, the size and nature of products dealt by these companies, etc., should be available. However, to compare better of its performance and position in the market, more information about companies chosen as average, the size and nature of products dealt by these companies should be available for better analysis. So without using any extra information or any extra formulas or any extra ratios, we were still able to make enough and more points for 12 mark question in order for the performance and position. Now, whenever you're doing the ratios part, because it comes out for 12 marks and all, try writing information in good clarity so that points are there enough over here. Now, definitely you can write these statements a little shorter if you want to, but as I was explaining the points, I just showed you that okay, this point can be written in this way and these points can be included. Even if you cut short maybe 1 or 2 points or maybe a little more from this, you'll still be good enough having points to score that 12 marks over here. So hope you have followed with the tricks and techniques of how to go about a ratio analysis question. And with this, we are done with the final 20 mark question of the March 2025 pre-mock financial reporting. If you have followed all the way till here, let us know in the comment section how these videos have been helpful in your financial reporting exam. Good luck with your preparations and see you soon.